Next question is this. A company operating in a country having dollar as its unit of currency has today invoiced the sales to an Indian company. The payment being due 3 months from the date of billing. Bill amount is 7500 US dollar and today's spot exchange rate is 0.015 dollar per rupee is equivalent to rupees 5 lakhs. It is expected that the exchange rate will decline by 10% over the 3 months time period, and in order to protect the dollar proceeds, the importer proposes to take appropriate action through foreign exchange market. So we understand it's a 0.015 into zero point 0.9. We are expecting the spot exchange rate to be 0.0135 dollar per rupee. That is 10% it will depreciate. The 3 months forward exchange rate is quoted as 0.014 dollar per rupee. You are required to calculate the expected loss, that is expected profit or loss due to transaction exposure, and to show how it can be hedged by forward contract. That is the question. I want all of you to give answer of the first question to me in the chat box. One more question that I would like to just ask you, that which company is exposed to foreign exchange risk? Is it an Indian company or US company is exposed to foreign exchange risk? Friends, over here we understand the consideration is in dollar currency term. So Indian company is exposed to foreign exchange risk. Let us have reading of the question to understand it properly. A company operating in a country having dollar as its unit of currency means there is a US company has today invoiced the sales to an Indian company. So they have exported goods to an Indian company. The payment being due 3 months from the billing. So the time period is 3 months, say for the credit. Bill amount is $7,500 and at today's spot exchange rate of 0.015 dollar per rupee, it is equivalent to rupees 5 lakhs. Kindly use your calculator. 7,500 divided by 0.015. Okay, so they have mentioned that say using the spot exchange rate, the amount is 5 lakhs of rupees. However, the consideration remains in the dollar currency only. It is not in the rupee currency. It is expected that the exchange rate will decline by 10% over the 3 months period, and in order to protect the dollar proceeds, the importer proposes to take appropriate action through foreign exchange market. So now there is an absolute clarity. Who is importer? Indian company. An Indian company proposes to take appropriate action through foreign exchange market. Okay, so we understand something like this. Listen carefully what I am going to speak. Payment considering the spot exchange rate is rupees 5 lakhs. Amount of the payment using the expected spot exchange rate is 7,500 divided by 0.015 minus 10%. So 0.015 minus 10%, 0.0135. 7,500 divided by 0.0135. It comes to 5,55,556. Means we understand that so the amount of the payment from the Indian company point of view will increase by rupees 55,556. And this is what we understand is the expected loss to the Indian company. And that is what we understand is the answer of the first question. Then the second question is here that we are going to read slightly later on. However, let us write down answer for the first question. So please write down answer for the question. In this question, comma, consideration is in dollar currency, full stop. It is a foreign currency for an Indian company. So, Indian company is exposed to foreign exchange risk. Full stop. Working note number 1, calculation of expected spot exchange rate for dollar per rupee after 3 months. In that write down spot exchange rate minus 10 percentage. So it will be 0.015 minus 10 percentage, 0.0135. This is the way we have the first working note. Working note number 2, calculation of amount of payment at spot exchange rate and at expected spot exchange rate. So here they already have provided about the amount of the payment using spot exchange rate. If at all it would not have been given, friends, then in that case you are required to make its calculation. It is an amount of 5 lakhs 7,500 divided by 0.015 and using the expected spot exchange rate. What will happen? It is 7,500 divided by 0.0135. That comes to 5,55,556. And lastly, calculation of expected loss. In that, payment at the rate expected spot exchange rate minus payment at spot exchange rate. 5,55,556 minus 5 lakhs. That comes to 55,556. That is the way we can compute the expected loss. Second part of the question. You are required to show how it can be hedged by forward contract. Please write down answer the second question. Working note number 1, calculation of amount of payment using expected spot exchange rate. I'm sorry, using forward exchange rate. In that, dollar and rupees, we have been provided that the forward exchange rate is $0.014 per rupee. So $0.014 per rupee. The amount of the consideration is $7,500. So it is equal to this amount of rupees. So 7,500 into 1, that does not make a sense, divided by 0.014. 5,35,714.29. Let us ignore the fraction. With paragraph write down. If forward contract is entered upon, comma, amount of expected loss 55,556, comma, will reduce to rupees 35,714. How it is calculated? 5,35,714 minus 5 lakhs. So the amount of expected loss 55,556 will reduce to 35,714. This is what we understand. So this is the way the profit or loss can be calculated by entering into the forward contract.